Hey everyone, how's it going? It's Russell Matthews here, and there are some early warning signs that are showing that Canada could be going down quite a scary path, and it has many people, including former Prime Minister Stephen Harper, making comments like these.
We have bubbles everywhere. In real estate and stock markets, you name it. Look, it's absolutely the case that we will have all kinds of solvency crises around the world, and we will have significant sovereign debt crises in the near years to come, very soon.
So in today's video, we're going to go over exactly what the concern is, how it could affect you directly, and what the government is planning on doing about it. But before we do, make sure to check out the links in the description where you can open up your own investment accounts. Okay, let's get into this. Now, all of this has to do with the insane amounts of money that the government is currently spending right here in Canada. It's important to note that they're not actually financing this spending with tax dollars, as many people believe. They haven't been able to do that in a long time. They actually fund this by essentially taking out a loan or writing a bunch of different IOUs called Government of Canada bonds. As a result, since the beginning of the pandemic, the Government of Canada has gone into unprecedented amounts of debt in order to fund all the various programs for businesses and for individuals that have helped keep people afloat during the crisis. And with this spending seeming like it's not going to stop at least anytime soon, and with more and more ideas of things like universal basic income and other programs that will cost even more money, some valid questions are being raised about just how Canada expects to pay for all of this.
So it is a lot of money. And I want to start by assuring Canadians that I take that very, very seriously. I think the first thing that should be reassuring to all of us is that our debt servicing charges are imminently manageable.
And there's something interesting inside of that statement. You can see she's definitely taking the tone of trying to sort of convince Canadians that everything is going to be okay. But the language she chooses to use is a little bit interesting. She says that the debt is imminently manageable. Now, imminently means in the short term, for the foreseeable future, in the next little while. Okay, it'll be manageable for that amount of time. But what happens when we get farther down the road? That's where the real problem is. The reason she's saying that it's all manageable over the short term is because right now in Canada, we have some of the lowest interest rates that we've ever seen in the country. Now, as a result, this means that the government's debt is also at a lower interest rate, and they can service that debt with less money. Of course, these interest rates are only low because of the way that the Bank of Canada has printed $4 to $5 billion every single week since the beginning of the pandemic. If you don't know how that works, I have a video on that, and you can check it out in the description. But what exactly happens if these interest rates start to tick up in the future? Well, let me show you some numbers that are going to have you a little bit concerned. Here's some information that I put together while I was doing research for this video, and bear with me, we're only going to look at these numbers for a little while, and then we're going to get into exactly how it can affect you specifically. This year, the Canadian government's debt is expected to hit $1.1 trillion, and this money that they've essentially borrowed, they're paying an interest rate of, on average, 1.84% when you consider all of the different interest rates they're paying on it. This means that right now, Canada's paying around $20.2 billion each year in order to keep on borrowing this money. Now, last year, the amount of money that the Government of Canada was able to bring in through taxes and other revenue sources was $334 billion. So that means that around 6% of all of the money that the government has collected via taxes and other sources, 6% of all of that is going towards just servicing our debt. But remember, this is during a period where we have historically low interest rates at 1.84% for the Government of Canada on average. But what happens when those rates start to go up like they may in the future? Let's first imagine something that's rather likely. Let's say that the interest rate that Canada is paying on its debt goes up from 1.84, just a couple points, up to 3%. In this case, Canada would have to pay $33 billion every single year in interest on that loan or on their debt, and that equals just under 10% of all of the money they're able to collect through taxes. Now let's imagine something a little more extreme. Back in the 80s, Canada's 10-year bond went up to 12%. So for this example, let's imagine that on Canada's current debt today, they start paying an average of a 10% interest rate. Now, based on their current debt right now, they'd be stuck paying $110 billion just in interest to service the debt that they currently have. And that equals 1/3 of all of the money that we're able to pay in taxes and Canada is able to collect in order to operate its services. They'd have to use 1/3 of that just to cover the interest payment. So I'm sure you can quickly see the problem here. If we start spending all of our tax money just servicing the debt that we have, paying the interest on the money that we've borrowed, we're going to stop having the amounts of money that we need in order to implement the important programs here in Canada. Many people have become even more dependent on those since the beginning of the pandemic, with the start of programs like CERB and CRB, and many calls for a potential universal basic income. We wouldn't have the ability to actually fund those programs if we're having to spend 33% of our money that is able to be collected from us on servicing the debt. So the government has to be thinking of some sort of solution to this, right? Well, let's take a look at what Chrystia Freeland has to say.
And we are working very hard right now to push out the maturities on our debt to lock in today's low interest rates.
So it seems that the government knows that this debt crisis could be coming, and it seems their solution is to try to lock in these low interest rates for as long as possible in order to sort of just kick the can down the road. And this chart shows exactly how they're planning on doing that. This is from the fall economic update that Chrystia Freeland put out at the end of November. And it seems they're going to try to change the types of loans that they're taking so that they expire far later, right? Initially, you can see here any of these darker lines. This is how many 10-year bonds they're issuing, and this is how many 30-year bonds they're issuing. So they want to make it so that there's more 30-year bonds than there are 10-year bonds, or at least the proportion is more 30-year bonds than it used to be. Now, this is just going to kick the can down the road 30 years until these bonds mature and we have to pay the money back or get another loan to cover them. And from the very same economic update, it seems that the government is going to consider trying to kick the can even further up to 50 years, where they say the government will continue to review options to extend the maturity of the debt in future years, including the potential reopening next year of the ultra-long 50-year bond. So it's clear they're trying at all costs to lock in the current interest rates for as long as humanly possible so that they can just not have to deal with this problem until down the road. And hopefully there's some sort of solution down there, but either way, we're not going to be the ones to have to deal with it. And the big question is, what are we going to do when we get down to that point in the road where we actually have to deal with this? Is the Bank of Canada going to keep on printing billions of dollars every week to keep interest rates low and potentially inflate away Canada's debt? Or are we going to get to the point where we're paying higher interest rates on all of Canada's debt, and as a result, we're not able to pay for the many programs Canadians have become dependent on? These are some of the big questions that we have to ask ourselves. And this isn't even something that's just happening in Canada. It's happening on a worldwide level. Now, I want to show you some comments that former Prime Minister Stephen Harper made. Whether you like him or whether you hate him, it's interesting what he has to say here.
That's completely different than what we were trying to do in 2008, 2009. I should add, much more dangerous in the long term than what we were trying to do in 2008, 2009. And the consequences of this around the world, I'm not trying to talk about specific governments here. The consequences around the world are very clear. We will leave this recession, the world, with a debt overhang that dwarfs what we saw in 2008, 2009. And what we saw after 2008, 2009 was, after financial crisis, recession, somewhat of recovery, was in a series of sovereign debt crises in various countries, Greece and Italy and Portugal and Ireland, we know them. This time, the debt overhangs by governments as well as businesses and households are much larger. It's absolutely the case that we will have all kinds of solvency crises around the world, and we will have significant sovereign debt crises in the near years to come, very soon.
So it seems that there aren't any simple solutions to this problem, and even if there were a straightforward solution, we'd have to depend on the government to properly implement it to sort of steer us in the proper course. As of right now, we don't really have an idea on what the current Canadian government is planning on doing long term about this issue, and we especially don't know because we haven't seen a budget from them in almost 2 years now. Now, that's an unprecedented amount of time, but there has been a pandemic in the middle, so it's a little bit understandable that we haven't gotten as many details, but we're looking forward to seeing that budget very soon. Around mid-April, we're expecting to see that budget, where they should come out with some sort of plan on what's going to happen here in the country for the future. But it seems very clear that they're currently between a rock and a hard place right now. Of course, a lot of the spending that they've done throughout the pandemic was necessary to keep people afloat, and it stopped us from paying a far larger human cost throughout the course of the pandemic. But at the very same time, Canada as a country, as well as the rest of the world, is facing this impending debt disaster. So it's going to be very interesting to watch going forward what different governments around the world choose to do. And of course, if you're interested in any of this information and want to be kept up to date when we see that new budget and when a plan actually comes forward, make sure to subscribe to the channel and hit the notification bell, because I'm going to be bringing that information for you right here to take a look at as soon as it's available. And make sure to take a look at the links in the description where you can open up your own investment accounts. Now, with all of these issues looming and potential currency devaluation in the future, it's no longer enough just to save your money. It's really important to have an investment strategy. So if you haven't already started thinking about it, make sure to check out those links and start your own plan. And with all of that said, thank you so much for watching, everybody. I hope this video has helped you out at least a little bit, and I'll see you next time. This channel is supported by viewers like you. Thanks, channel members.